Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. A very brief, casual overview today of last month's performance, kind of like a quasi-quarterly performance review for two portfolios that are available to the public. So let's get cracking. We'll get straight into it. Disclaimer, nothing that I say is advice. You need to do your own due diligence and not take anything that I say as advice. It's just my opinion and what I'm doing, sharing it with you lovely people in the rest of the world. So this is the performance for 2023 of the Crassus investment portfolio. It's a deep value fund aimed at compounding at over 20% year on year over the longer term. It's available on eToro. The link is in the description if you would like to copy it, or if you would just simply like to add to a watch list. Totally up to you. Now, yeah, we're hitting the benchmarks already with the last quarter still to come. I have been trimming positions, taking a little bit of profit, which means that you may not see quite so much volatility, but I'm looking to really make more of a consolidated portfolio over the long term, which would then lead to a little bit more volatility at times, but with the ability to outperform. So we've had a couple of months here where we've nearly tipped over double-digit months, and that's been obviously based on changes of capital flows moving into the energy thesis, which is really starting to play out. So that's that. We'll see how we go. This is the portfolio, an income-orientated portfolio. Although the eToro portfolio is also yielding extremely high dividend yields, thanks to some of the energy producers from Latin America that are paying large dividends. In any case, the Maverick Life link will be in the description. You guys who follow get access to my trades using not always, but mainly the options market to get weekly and monthly income. Since the 31st of July, okay, so essentially 1st of August, we've basically put up 10%. Okay, so I'm trying to hit at least 2.75% per month regular returns. Again, it's income focused and using derivatives, but so far, yeah, we've smashed that out of the park. So we'll see how we go with all of that. So brief commentary. Again, I'm trying to reduce the size of the portfolio at the moment because I don't see an awful lot of value in terms of an abundance of different positions, and so I'm trying to just simply get more and more concentrated into positions that I know, like, and am confident in, and we'll stick with those come what way over the next part of the cycle. It's the same process as usual, and looking for very high free cash flow yields, at least 20% free cash flow yield, unless there's a huge discount to net asset. And I'm looking to get a lot of that ideally returned via dividends, although share buybacks are also very, very good. Just want to make a remark recently on the performance of the tanker market. Very rare that I time a market as well as I do. Normally I'm waiting for the thesis to take off, but tankers have absolutely rocketed recently, and that's also been a key part in the income portfolio for the options Mavericks, and in the Maverick Life publication, we've been able to make some good gains there. So here you'll see, for me, probably the two big ones. So DHT is in the portfolio. Frontline would have been in the portfolio, but the thing just took off. Frontline more diversified. I really like DHT for the very fact that it is a pure play on very large crude carriers. The order book for those look absolutely just tapped out. It doesn't look like you can get another one of those things built anytime soon. That is generally the case in the shipping market. However, containers, I think, are cooked. I'm not interested in those. And in terms of the LR1 specific type of crude carrier, and there are some product carriers that are not really taking my fancy at the moment. Apart from that, the rest of the tanker market looks very good. So initiated a very small position here where there was very little divergence between the two names. And then, as you can see, when we saw this unexplained weakness in the crude carrier DHT here, I allocated much more heavily. And since then, we're up sort of 13%. And I think that there's a long way to go. Looking forward, my question is, where's the value relative? I like all of these things that I'm about to mention. How do I go about the allocation? That's what's on my mind at the moment. And it's position size, if you listen to Stanley Druckenmiller, can be just as important as your allocation. So Uranium, silver, offshore. I still love all of those. I would love to get some exposure to metals. I'm just trying, particularly with copper below $4. I'm just trying to work out how exactly I want to do that. So if anyone's got some suggestions for me to take a look, drop them in the comments. Coal is, to me, the thing that no one's talking about. I just did a podcast with Rick Rule 2 days ago, and I think Uncle Rick is quite happy with the with the coal sector also. So from the top, uranium. If you've been listening to Cuppy recently, I think he's now that they've just had the World Nuclear Association Symposium, and they just everything about the thesis really does seem to be coming to light in terms of there is no more secondary supply. There's no more readily available supply in the spot market. Yes, Kazatomprom and Cameco will be increasing production, but that production has already been contracted. So for those utilities starting to roll over now, they're really having to reach out and make new friends with the developers or the producers that have been on mine shutter that are looking to restart. Now, they're going to need much higher uranium prices than the $72, $74 that we've seen, even though uranium is up over 40% on the year. So for the eToro perspective, it's difficult to play this. There really is the ETF. There's Cameco, but for various reasons, I'm just looking for a broad sector exposure. And URA is the way to do it in eToro. Unless someone knows something that I don't, please do drop in the comments if they've added other uranium plays to eToro. Silver, I mean, silver's a frustrating one. The thesis since like late 2020 to me has been very clear. It went on a massive run. I had some bullion actually. I did pretty well there, but it's probably it's the second most used commodity after oil. Silver is, and it seems like such a straightforward layup thesis. It's just taking forever and ever to take off. And I think that now with the depressed sentiment in the sector is really a time when I'm looking to reallocate towards silver. But again, it's tricky to know how to play that. Do I go the silver miners? I mean, they are really quite a unique beast. Or do I just hold some bullion in the portfolio and allow that to improve over time? I do have access to the royalty and a tiny position in wheat and precious metals, but we'll see. You always have to pay up for quite a lot of those. Offshore, if you take a look at some of the comments that I'll mention earlier, offshore looks to be absolutely ripe for a prolonged bull market. A lot of people were thinking that it might just be a rocket ship flash in the pan, but based on the comments that I'll mention in a moment, it doesn't appear to be the case. And again, I want exposure to metals. I currently have allocated towards Sibanye-Stillwasser. It's just so damn cheap. I believe that the price has factored in, or hopefully all of those risks, but it is a risky play, no doubt about it. So I'd be looking to add to Sibanye on weakness. It's just one of the very few plays on platinum in the world. Platinum, I think, is really been beaten down. I would also like access to Vale, and I may continue to add to that. I'm just a little nervous about the iron ore price. If we on the one side, the West seems to be going into recession. Chinese data does not appear to be anywhere near as bad as we've been led to believe. So I've just got my eye on it for now. Coal, I've moved away from more of the metallurgical coal to mainly thermal with some seaborne exposure. We played Peabody perfectly, had some run up, took some profits, and I'm rotating that towards Whitehaven coal. LNG, of course, New Fortress Energy, also like Cool Company, and I own that in my in one of my other portfolios, but it's not available on eToro. So let's talk about offshore. We've got CEOs from Seadrill, Technip, Valaris, and Noble. And I'm going to read it out loud, so forgive me. Every time I try and speak to a shipyard, there's the CEO speaking to hang up on me. This is a distraction, an abstraction. No one knows what it's going to cost, and no one's going to build one. Maybe $1 billion, maybe 3 to 4 years to build just one. We've got a baseball bat at the office, and we use it to hit people if they say the word new build. We need $1 million a day or 1.2 million day rates on a terminal to justify one. Wow. So if if you believe that, we need to see day rates more than double from where we are here, and it needs to be a prolonged cycle, because you have to have that. If you're a shipbuilder and you're the CEO of a Seadrill, and you are going to reinvest in growing your fleet, you need to know that there's going to be a sustainable market there, and learning from the PTSD of post 2014 in this particular market sector. If we go to TechNib, we're seeing an increasing demand for longer duration contracts. There it is, and a focus on security and capacity. No one is building a new rig, maybe ever in our lifetimes. Now, I don't know about that. I think eventually someone's going to have to be building some rigs. If not, you know who will? Petrobras. They'll either buy out these companies or they'll sort something out, possibly down in Brazil or off the Gulf of Mexico, where they have access to cheaper but good labor. And they may just invest in a shipbuilding yard themselves. Probably it's more likely to see a buyout. So I think that we will see in our lifetimes there will be a new rig built, but it may take a decade. I don't know. Who knows? Valaris, we have zero expectation of a new build cycle. We will probably never see it happen. If day rates hit where they need to hit, these guys will not be able to help themselves. Trust me, that will happen. But again, I do think it will take a long time, and there'll be a hell of a lot of money for these guys to make before then. This is key. New build parity is about 900,000 for 10 to 15 years. In other words, where you're at, I don't know, mid 300,000 day rates at the moment, which is a big improvement from even 2 years ago. That would need to triple, and you would need to have a contract in for a decade, maybe 15 years, if you believe the Valaris CEO, before you start to see any significant additional supply come onto the market. So just let that sink in for a moment. New build parity 650 for 15 years for Noble for some of their fleet. So you can compare and kind of read between the lines there. I think that Offshore is extremely interesting, and I want to add to the allocation. Again, it's not easy to do that, so I'm going with the ETF for the etoro portfolio, and then using the options markets on certain names, which if you're in the Maverick Life, members have access to all that. So how to allocate relative value? This is the headache. So do we allocate more to uranium? Do we allocate more to offshore? If you're looking at where uranium is compared to offshore as a ratio in terms of the two ETFs, this is the miners and the OIH ETF. At the moment, you'd be suggesting that you'd allocate a little bit more to offshore simply based off this particular chart. What about silver and uranium? Well, at the moment, you would be looking at, excuse me, I'll go back to that chart. You, again, the ratio has come down a lot since 2017, where it took a lot of uranium to buy the same number of units of the offshore ETF. So I hope you're all following that. I'm using this because it's a very easy example to illustrate. And then down here, you need a lot less units to buy the same unit of OIH, which means that obviously the uranium ETF, the URA ETF, has increased in value at a faster pace than OIH. So relatively at the moment, OIH, all else being equal, would appear to be relatively better value. I should have slowed that down before. So we got there. Silver and uranium, where are we? So we saw the silver spike 2020, where it just went bananas. So again, that would have taken a lot more units of uranium ETF to buy silver miners. And then down here at the moment, everyone's given up on silver. They've thrown the baby out with the bathwater. And uranium, you need only a few units to buy that same number of silver. Okay. So again, it's tempting me for more of an allocation. I'm still working out exactly how I wish to approach that. So I hope you like that update. If you do wish to copy the portfolio, just click the link in the description and it'll all be taken care of for you. Please do like and subscribe. Apparently, the majority of the views on this channel are from non-subscribers. So let's fix that, please. It doesn't cost you anything. Just hit the subscribe button, leave me a comment, hit the like button. I'd greatly appreciate that. And other than that, I wish you all the very best, and I hope to see you in another video shortly. Take care, guys.